All right, we're going to go ahead and get started. Welcome, everybody. Thanks for joining us today. This is the Ticker Tape Educational Series and kind of a cool presentation tonight. We've got the best of ticker tape. So, what I've done is taken some of our most popular presentations, pulled out a couple key slides. I'm just going to fly through the information. If you see part of tonight's presentation that you like, you want more detail, go find the original and you'll get sort of the full scale presentation with all of the good stuff in it. So first of all, this comes from the How to Spot the Best Investment Deals presentation. A couple of real quick slides I want to talk about. One is, we talk at Ticker Tape about how we encourage investors to invest in more private equity type investments. A bunch of reasons, but we think they've outperformed over time. They're a better performance driven metric for getting to retirement and building the nest egg that most investors want than participating in public markets. But lots of folks that come to us say, man, Tom, I've done some deals. They always disappoint me. I always lose my money. This happened, that happened, et cetera. So why is that? What is it that investors do wrong that lead to disappointing results in private deals? Well, obviously, the biggest category, the biggest impact is going to be if you're not doing adequate due diligence. So at Ticker Tape, we talked a lot about this. Reach out to Rita. We'll send you our due diligence checklist for various types of deals. But you gotta actually do your due diligence. And remember, I'm a lawyer. I've been representing investors for going on 30 years now, trying to get their money back when they lose money in a deal. And what I've seen more than anything else is investors actually had the information in their possession before investing that would tell them not to do the deal, but then they invest anyway because they're not conducting actual due diligence. Number two is fees. I see people overpay in fees all the time. I saw a deal where a guy invested in a real estate deal and they gave him a preferred return of 7 or 8%, whatever it was. And I asked him what his profit split was on the back end, and he said, well, none. What do you mean? I'm like, oh my gosh. So make sure you're getting a good deal. They're not overcharging you fees. Another big one, and this is really hard. I know this one's more difficult to solve, but it's not seeing enough deals. So many investors come to me, they're like, oh, I invested in this deal, it didn't go well. Like, well, how many deals did you look at before you invested in that? Was, oh, well, this is just the one that my neighbor did, and so it was the one I saw, and that was the one I decided to get involved in. Well, that's not a good strategy, right? You need to be looking at lots of deals in the marketplace so that you have an understanding of what is out there. What is a good investment? What is not a good investment? And that's what Ticker Tape does, right? We see tons of deals. We have lots of partners, over 300 now, that are viewing deals in their own everyday lives and then feeding information to us. So it gives us a better landscape picture of kind of what's out there and what opportunities exist for us to invest. Another thing is not being able to negotiate terms. If you're just an individual dealing with some sort of institution, you probably have no negotiation power. And so that's why, frankly, we created Ticker Tape, was it gives us a better position vis-a-vis those folks. And then the other thing is lack of downside protection. So many investors like early stage deals. Oh, it's a cool new AI company or a new software company or a new mobile app, but it's an all or nothing proposition. You invest the money, you're either going to make a bunch of money or you're going to lose everything. And so make sure you have some sort of downside protection. Red flags. This is one I love to talk about. Things you probably have seen, but you maybe didn't think through what it meant and literally classify it as a red flag. So the first one that I see all the time is unreasonable financials. And they can be unreasonable for any number of reasons, but if it sounds too good to be true, it may not be. But you need to find out why it is true. Or maybe you'll find out that it is in fact unreasonable and not a good investment. The other one, and you may have heard me say at Ticker Tape, this is a bright line rule for us. We don't invest in any deal unless we know the dogs will eat the dog food. What does that mean? Well, you can imagine a situation where someone comes out with a new dog food and they tell you, man, it's fantastic, it's super healthy, the dogs live longer, they don't get sick, they have more energy, their coat is shiny, all those things. Well, the short story is those things are all irrelevant if dogs don't like the food and won't eat it, right? Because you'll get some buyers to buy one bag, but they're not buying a second, third, fourth, fifth bag. And so the company is doomed to fail. Make sure you know for certain that you're not looking at 6 months of history during a seasonal peak. For instance, if you look at a tour company in September and look at the 3 months prior, of course they're going to have lots of sales during the summer, but what's it going to be like in January? Make sure you have a good picture of what the ongoing sales are going to be. That, in other words, the dogs will eat the dog food in January just like they do in July. Another big one for us is whoever's sponsoring the deal, if it's a real estate management company, if it's an individual founder, they have to have a substantial personal investment in the deal, skin in the game. Not that they gave up salary and got stock, or not that they have some sort of back-end compensation. I want to see that they have money at risk, money they've already earned and already paid taxes on, that they're now putting at risk in the deal. Ask me about the comment about the farmer in the Soviet Union won't stay up all night with the state's pig. That's the thinking there, is you got to have skin in the game. Management track record. What is the track record of the management team? If they don't have one, that's a red flag. High fees or salaries for the management team, and you got to look at that, right? Hey, we're going to give you 80%, your share of 80% of the profit on the deal. We're only taking 20%, but they're paying themselves $400 grand a year to manage the property. Make sure you know all the compensation that's going to the promoters / the management. And then poor GP-LP alignment. Several of the lawsuits that I've handled for investors over the year have had a problem here where the investor has a different type of equity that is inferior to the management and the founders. Make sure you're aligned. Another presentation that we'll pull from tonight, and this is probably the most significant one for tonight's presentation, is how to invest like the ultra wealthy. And you've seen us do posts about this and a few presentations about it, but I wanted to pull out some of the information because I think it's so valuable and so sort of hidden from the average investor out there. The first thing is, what's an ultra wealthy investor? I'm talking about guys in the 9-figure net worth area, 100 million and up into the billionaire level. And what we've discovered through extensive research is those folks have very different portfolio allocations than what you and I were told we should have. For instance, typically they only have 10% or so in public equities and about 10% or so in publicly traded bonds. That's much lower than what I was told growing up, or as a young adult, that I should be allocating my assets. Ultra wealthy folks avoid volatility. We're going to talk more about that in a minute. But look at that chart: 26% in private equity venture capital, 20% in real estate direct invested and funds, 15% in hedge funds alternatives. So you can kind of lump the hedge funds one with the private equity one across the diagonal. For really 41% of their investment portfolio is in private deals and hedge funds. Then you've got cash and liquidity, 7%, philanthropic capital. They've created a foundation and put money in it, that sort of thing. And then 5% for hard assets, art, gold, etc. And so, guys, start moving towards this, right? This is a wake-up call that you've got too much of your portfolio in the public markets. I certainly was guilty of that years ago. And we'll get into some of the big reasons. The biggest one is that private equity outperforms the public markets over time. The graph right there says it all, but why is that, right? Why is it that private equity deals outperform the stock market? Well, the short answer is that by the time the company goes public, the money's already been made. And you can probably conclude that the increase in the spread is because in the recent decades, companies have been going public later in the process, so more of the money was made before they went public. The biggest thing, though, the biggest component of that factor is the volatility. So let's talk about that. One of the things we learned through doing research about these topics over the years is that avoiding volatility is more important than getting a high rate of return. And when we started researching this and analyzing it, I see that somebody said that, but how do I know that's real? Well, the best example we found so far is David Swensen. This guy, who is no longer with us, came in and became the chief investment officer for Yale's endowment several decades ago. And he came in and said, look, I don't want to participate in stock market volatility. And I'll show you the effect of it here in a minute. And so what they did is they changed the Yale portfolio to only be 10% in US stocks and bonds. They've got about 15% of foreign equity, some of which is publicly traded, some of which is privately held, and then the rest in private deals. Now, was that successful? Well, he grew it 30 times. It's now a $30 billion portfolio. And so a lot of investors now are modeling after what they call that Yale model. And one of the keys to it is, again, avoiding volatility is more important than higher returns. So look at this example. We're talking about $1 million portfolio. And in both examples, portfolio A and portfolio B, the average annual return is 9%. Same exact annual average return. However, portfolio A is in high volatility, meaning, for instance, the stock market and bonds. Portfolio B has low volatility, more private equity, real estate deals, etc. When you average out the annual return, it's the same. But after 10 years, the guy who has the high volatility portfolio with the same annual return only has 83% as much money as the other guy. And after 20 years, it's obviously worse. You only have 69% as much money. So to me, this is just screams at me, oh my gosh, I've got to rethink how I'm investing if I have a high percentage of my assets in publicly traded markets. Another presentation I thought we'd talk about is the one, we've done this one a few times, very popular with our audience, tips and tricks for high income Americans. Go look it up. There's a lot of great content in there, but the one that seems to kind of get people's attention the most are the tax and estate strategy components of it. Hire your children or your grandchildren in your LLC. You can pay them $13,850 per year, tax-free. What does that mean? Well, your business gives them $13,850 a year. They pay zero income tax. That's the amount that an 18 or younger person can earn without paying any income tax. But you get a $13,800 deduction on your tax return. And then, of course, that money goes into an account for the child. If you're trying to save for their college or build up savings for them, that's great. If not, open a checking account for them, put their payroll into that checking account, get a debit card, and have the kid buy the groceries every month or whatever it is, pay the cable bill, whatever it is. And so, in other words, you don't give up the money. You can still use the money for family, expenses, but you got that tax deduction right there. Now, of course, the child has to have an actual job. They can summarize documents for you. They can go do research projects online for you. They can reorganize your computer files, all kinds of stuff that youngins can do for us that is legitimate work. Maybe they work a couple hours a week. Nothing says you can't pay them, $500 an hour or something. But the notion is they have to actually work for the business, perform some sort of service, and then you can pay them and get this tax deduction. Number two, if you have IRAs or Roth IRAs that are not self-directed, call Rita Carpel, have her help you, walk you through getting them set up as self-directed IRAs. That will allow you to invest in anything you want: gold, coins, Bitcoin, real estate deals, oil and gas deals, or publicly traded stocks if you want to have some of those in there. You should also watch our presentation about how to allocate your investments among your different accounts. Roth IRAs should have different type of investments in them than a traditional IRA. And so make sure you pay attention to the tax implications and the appreciation implications of all sorts of different investments. Some things you shouldn't put in your IRA. They should be kept out of your IRA accounts. Make sure you're passive loss harvesting. I get frustrated when I hear investors tell me they've got a passive loss rolling forward on their tax return. we have strategies you can deploy to capture those passive losses and take the tax deduction against your active income. Sometimes it takes a little effort, but it's very doable, very easy to do. And then think about having a family trust and a family foundation to create more of that legacy for future generations, but also save taxes in the meantime. Remember, if what we're talking about is how do I increase your returns, it's not necessarily about what percentage return you get on your investment. What really matters is how much money is in your portfolio or your account at the end of whatever the time period is that's relevant, right? So if I can put more money in your portfolio by reducing your taxes year after year so that you're putting more money into your self-directed IRAs and your traditional investment accounts and so forth, you're going to end up with that larger amount. So tax benefits along the way are critically important to your long-term investment performance. Well, that's all the substance today. Reach out to Rita Carpel if you have any questions. There's the website, ttifund.com, where you can get access to all the above content that we talked about, etc. Make sure you're following us on LinkedIn, Facebook, YouTube, etc. I'm going to start doing more Facebook Live appearances, talking about some of this educational stuff. And also, obviously, everything we're generating is getting posted on those accounts. If you haven't already done so, you're welcome to reach out to us for a personal consultation. This is what I've been doing for 30 years as a lawyer, as an investor, helping people with business advice, tax advice, legal advice, and investment stuff. So give us a shout. We do it absolutely free of charge for Ticker Tape members. So reach out and we'll happy to set up a call and help answer any questions for you. We talk about everything from tax, advantage strategies, investment ideas, how to increase your passive income, how to improve your risk return profile of your portfolio without, we want to improve your returns without significantly increasing your risk. Little tips like rent your home from yourself, set up a business. If you don't have one, have it rent your home several weeks a year. Again, straight up tax deduction. And 100% legitimate. All kinds of ideas for finding deals, etc. Last but not least, you probably have heard that we have 4 open pre-IPO deals. Of course, Utility Rescue is our favorite. We also have Kraken, SpaceX, and Anthropic. If you're interested in participating in buying shares of one of those companies before they go public, give us a shout. We'll help kind of tell you what we're doing, and you're welcome to join us. Or if you don't want to be part of our deal, you're welcome to kind of take what we've learned from the process and apply it for yourself. That's it. I'm going to call it a night. Everybody have a good one, and we'll see you next week, same time, 7 p.m. Eastern for the next installment in the TTI educational series. Have a good one.